All right. Hello, everyone. Thank you so much for joining. Welcome to our Last Mile Distribution Investor Forum, which is all about shining a spotlight on the capital continuum. My name is Emma Collenbrander, and I'm head of the Global Distributors Collective. There are quite a lot of logos on this slide, but each one is here for an important reason. So I just want to take a minute to recognize them. The GDC is hosted by Practical Action alongside strategic and implementing partners Hystra and BOP Inc. We have been collaborating since 2018 to bring the GDC life and to build what is now a very vibrant community of last mile distribution companies. This event is supported by our partner GET.invest, who are doing a lot of thinking on how we can make capital more inclusive and more accessible, not least for the companies that we are here today to discuss. And we at the Global Distributors Collective are very happy to be co-hosting today's forum with D-Prize and Acumen. D-Prize have played an essential role in building the last mile distribution sector. They've funded over 200 distributors to date, and they've been the first funder for many GDC members. And Acumen is one of the first impact investors to really advocate for the importance of last mile distributors in reaching low income consumers. And we've been really impressed with their commitment to do more in the sector, including by designing a new funding vehicle to support last mile distributors that Sarah will talk about a little bit more today. So here's a look at the agenda and objectives for today. We've got 3 parts of about an hour each with a break before we move into part 3. So part 1 is about understanding the challenges and opportunities across the capital continuum. I'll briefly introduce the conversation and you'll hear from our co-hosts, D-Prize and Acumen. And then my colleague Fede will walk you through the key findings from our research into the last mile distribution capital continuum. And that's been based on interviews with a large number of funders and GDC members, some of whom are on the call today. And we will hear from GDC members Easy Solar, DivaBits and S-Mart sharing their experiences navigating the capital continuum. So for this first part of the forum, please just feel free to drop any questions you have into the chat and we'll try and answer them as we go or follow up with you afterwards. So part 2 is going to be a panel conversation, which will be moderated by Divya Balakrishnan from GET.invest and features 4 speakers who've adopted models that focus on investing in last mile distributors and building their investment readiness capabilities. And finally, part 3 is about designing solutions to fill gaps in the capital continuum. So we'll spend about 45 minutes in breakout groups, and then we'll come back to plenary to feedback and close. So let's kick off part 1 of the forum with a little bit of scene setting. Why are we here talking about last mile distribution? We all know the stats. There are millions of people around the world who lack access to products and services that can improve their lives, whether that's electricity, clean cooking, safe water, health, hygiene, nutrition, or agricultural products and services. And we also know that people who lack access to beneficial products and services have low and unpredictable incomes. They're particularly affected by climate-related disasters, and they often live in remote areas or fragile and conflict-affected settings. So while the access gap can be partly addressed by extending infrastructure and service delivery, this requires large volumes of public investment and takes a lot of time. So for most people lacking access, the fastest and most efficient way to achieve impact at scale is through beneficial products that are delivered by the private sector. And the specialized companies that exist to fulfill this role are what we call last mile distributors. Last mile distributors are a diverse group of organizations with diverse impacts. What they have in common is that they are engaged in distribution of beneficial products to households that are poor and or remote. So just to give you a quick overview of who we're talking about today, I'll just share some key stats about GDC members based on our most recent member survey. So members operate across a wide range of geographies. They work in 58 countries around the world. They sell a diverse range of products, as you can see here, and 68% of GDC members sell more than one product category. They participate in a range of activities across the value chain. 78% provide consumer financing and 98% offer after-sales service. While the majority of members are young and small with annual sales turnover of less than 500K, there's a good chunk of distributors that have grown beyond $1 million in annual revenue. Over 3/4 of members are local companies. So in other words, they are wholly owned or partially owned by people from the country in which those organizations operate. And finally, members have reached on average 217,000 people to date. 69% of those people live in poverty on less than $3.20 a day. So that means that in total, GDC members have reached more than 38 million people to date. Final note, which is that most last mile distributors are for-profit companies and they're striving for commercial viability. There are some distributors that operate as pure not-for-profit models, and they use grants to achieve impact that's just not possible using a for-profit model. And that's because they focus on reaching the ultra poor or the very hardest to reach customers. And these kinds of not-for-profit distributors also play a really important role in the ecosystem in terms of advocacy, in terms of stimulating local entrepreneurship, and innovating around business models. But given the nature of today's forum as an investor forum, the focus of today is on for-profit models. A quick note on the access to finance challenge and opportunity. The importance of last mile distribution is increasingly recognized. So we're seeing growing interest in working with product agnostic companies, not just tech companies. We're seeing an appetite to do more to support local companies, and we're seeing a growing understanding that profitability isn't always linked to scale. And as you can see from this quote from Acumen, there are many impact investors who are rethinking how they deploy capital. Investors are also seeing that last mile distributors are increasingly professional. They are growing despite setbacks from COVID-19, and they're becoming more sophisticated in operations, particularly in terms of how they collect and use data, how they approach sales, after sales and marketing, and how they manage credit risk. But capital is still not flowing into the space at the volumes that we need. Access to finance is still the #1 challenge for last mile distributors. 70% of our members in our last member survey cited it as being their top challenge. So to unlock the full potential of this sector, we need more types of more capital and more types of capital. So grant, debt, and equity. So, as many of you know, we did hold a last mile distribution investor forum in April last year. And this was the very first time that donors and investors had been brought together to understand the barriers to access to finance for this unique group of organizations and to talk about opportunities to improve the current state of play. So we had 59 different funders represented in that conversation. We did an exit poll with that group to understand what funders wanted to see from the GDC moving forward. So you can see the results here. They particularly saw a role for the GDC in funder coordination and information exchange, benchmarking tools to assess distributor performance, and production of data and insights about the sector. So as we've been working on our access to finance agenda, we've been trying to drive forward some of the ideas that came out of the forum, taking into consideration what funders said they felt that the GDC is well placed to do. And our forum today is responding to that demand. What's more, we've now developed a new strategy for the GDC with a big access to finance focus. So we are increasingly supporting distributors to matchmake with appropriate investors and helping investors to build pipeline. We are working on tools to build the finance readiness of distributors, and we'll publish those in a few months. And we're inputting into the design of new funding facilities that are appropriate for last mile distributors. So we hope that that reassures you that we are absolutely committed to supporting those who are in this virtual room, as well as others in the wider sector, to drive forward solutions. We've also been pleased to learn about new collaborations with investors and funders that have sprung up as a direct result of our forum last year. So we hope that this event can similarly serve as a springboard for helping people to connect and collaborate on this topic. So our 2021 Investor Forum was closed to funders who had an interest in last mile distribution, and that was a direct response to requests that were made by funders during consultations. And we think that that was a helpful starting point for the conversation and to create a space for funders to ask questions and speak openly about their experiences. But we're very, very pleased to now be opening up this conversation to include the most important stakeholders, last mile distributors, and to let them speak for themselves. We have a good sense of who is in the room today because we know who registered, but it would be good for you all to get a sense of who's here and to see the balance between members and funders and who is interested in this topic and working to move the needle forward. So I think we're going to launch a poll. If you can please let us know which kind of organization you represent, that would be great. Thank you. I'll just give it 5 more seconds. All right. Share the results. Okay, so as you can see, a nice kind of diverse audience. You will notice a glaring absence of commercial banks, local banks, and that's a reflection of where capital in the sector is coming from. Our last research piece found that only 1% of the capital that's been raised by GDC members is from local finance institutions. So nice to see this diversity and range of companies in the room today. Okay, so that is enough from me. In summary, we are very pleased to have all of you here. Thank you so much again for joining. And let me hand over now to Nicholas Fuso from D-Prize to share some of his reflections.
Thank you, Emma, and hello, everyone. I'm a huge fan of the GDC's work to support last mile distributors. And so I was really honored when they asked me to share some personal reflections on the capital continuum. So that's what I'll be doing today. So my name is Nick Fuso. I am the co-founder of D-Prize. We are a grant-funded nonprofit organization, and we were founded in 2013. I think there are 2 things of what we do that are really important for you to know about today. The first is that we give grants exclusively to distribution-focused organizations. We believe last mile distributors, LMDs, are the best way to distribute some of these existing evidence-based poverty interventions that we know help people, but still have large access gaps. We're currently making 30 to 35 grants a year, and we expect that to grow. The second thing you should know is that we only support new organizations that are in need of startup grants, really to launch a pilot. So our grant is typically $10,000 to $20,000 US. And it's, again, offered at the earliest stage. And so because of this, I mostly think about that earliest part of the financing spectrum that we'll be talking about today. The main message that I wanted to share today is that I believe supporting LMDs is a strong strategy for building successful companies and for having them grow to have a large impact and reach a lot of people. And I believe there's a lot more founders who could grow an LMD to a large scale and help a lot more people. But right now, constraints in that funding continuum are really slowing or stopping them. So my belief in an LMD-focused approach really comes from our experience here at D-Prize. So our theory is that if we plant a lot of seeds with these startup grants, that a portion of those companies will grow. And over the last 9 years, we've given over 200 startup grants to different LMDs. Actually, can we go back 1 slide? Thanks. So we've given over 200 startup grants. 13% of those that have exited the pilot stage have grown to serve at least 100,000 people within their first 5 years. And this is what we call scaled on our chart. Or they're on track to do so. That's what we call scaling. You'll actually hear from 3 of the companies that we've helped seed today. Easy Solar, S-Mart, and DivaBits are all on the call today, which is really exciting for us. So this strategy has been really great for D-Prize. The power of this network is that cumulatively, we've been able to reach 7.5 million people, which is mainly driven by those top performers, those 13% of companies we've helped seed. So I believe that there's many more founders who could grow an LMD company is also based on our experience. So this success that we've had so far isn't from investing in the biggest companies with the most bankable track records. In fact, it's really been the opposite. We exclusively aim to support ventures that we believe wouldn't otherwise get support from anyone else. So because of this, our portfolio today is made up, again, of new organizations, but primarily underfunded organizations. So 80% of the ventures that we give seed capital to have raised less than $5,000 prior to our grant award. So they don't have money. The organizations also tend to be led by local founders. To date, 90% of the ventures that we help seed have a founder that's local to a low to middle income region where they're going to operate. Let's go ahead to the next slide. So this has worked really well for us. And I think that there are many more LMDs that could grow and scale. But unfortunately, I think there are constraints in the funding continuum that are slowing or stopping that from happening. And this belief really comes from the interactions that we get to have with our LMD founders. We recently worked with an outside consultant to really better understand what our founders are facing. And the main message that we heard from everyone is that there is just not enough funding for LMDs that aren't the largest and the biggest in the room. Our founders are saying things like, there's funding out there, but it always goes to the big established organizations, and competition's tough. Funders aren't interested in startups, that type of thing. I think the decision to always fund the biggest, most bankable organizations makes sense from an investor standpoint, but the unintended consequence is that we're leaving a lot of LMDs out. And again, based on our experience at D-Prize, we think LMDs that aren't the usual suspects can often end up being a really top performer. So my hope is that these conversations that the GDC is helping host will help the funding community really strengthen the capital continuum so that it works for more LMDs. We at D-Prize, we're really big on this direction. And that's why this year we are trialing a few programs really meant to help push our early stage organizations further up the capital continuum. So some of the programs we're trialing are doubling the average grant size that we offer to some of our pilot organizations. We're dabbling with follow-on funding. We're trialing a program to offer 2 times that initial grant size to some of our organizations. And we're also launching capacity training specifically focused on improving fundraising outcomes. And again, the hope is that we're pushing our ventures further up this capital continuum. And then my hope is that some of the folks on this call today, also at the early stage, will be reaching down lower toward us so we can start forming a bridge and closing these gaps and see more of these LMDs follow the path on follow a path to scale. So that's it for my reflections. Thank you everyone for listening today. And with that, I'm going to pass the mic on to Sarah from Acumen.
Thanks, Nick. And good morning, good afternoon, everyone. I'm Sarah Bieber from Acumen. Acumen is a early stage venture philanthropy investor with 20 years of experience investing in companies that are serving communities that are living in poverty. The slide that I have here is a very energy-centric slide, but Acumen actually invests across a number of sectors: agriculture, workforce development, education, but energy is our largest portfolio. And you can see here that we've been investing in energy companies since 2007. We now have 40 energy companies in our portfolio, and that includes a number of last mile distribution companies, including Easy Solar and Frontier Markets and others that are GDC members. And we invest across the capital continuum that Nick was just referring to. So everything from investing early stage seed and Series A pioneer equity up to growth stage equity with returnable capital funds. You can go to the next slide, Emma, or whoever's controlling it. So, you know, as Emma mentioned at the top, Acumen's been rethinking how do we direct more capital to smaller, locally owned companies that are better equipped to more sustainably serve last mile customers. And we've been, you know, doing that thinking for a number of reasons. One, you know, the list on this slide is that they just are better equipped to meet the price point to help low income customers afford these products and services. And they offer leaner cost structures so they can do that more capital efficiently. That's not a word, but we'll just leave that there. But they need that capital, right? And they can't scale their operations. They can't provide consumer financing. They can't streamline their distribution and therefore reach more customers that could maybe afford these products and services, but are just out of reach for a purely commercial play. And so how do we get more capital to them and why, right? And so so we can go to the next slide. One of the big questions we've been thinking about is like, what is the advantage and why of investing in local and last mile distribution companies? You know, for long-term economic development, they should be the most efficient and they have the knowledge about the local where they're operating, about the local environment. But it isn't happening because local capital markets are constrained. Emma mentioned that there are no local commercial banks on this call, right? That's been a reality, unfortunately, in this industry for a while. Foreign investors, therefore, try to like make up the space in between in the capital continuum, but local entrepreneurs tend to not get the benefit of the doubt from local investors. They have biases, and they're often deemed as too risky. And Acumen sees ourselves as sort of an investor where we could take a different tack and really drive more capital to those companies. And so what's that going to take? You know, we've seen, and you can see on this slide, you know, under the business and ecosystem sustainability, you know, 42% of our distressed investments in our portfolio have been because expat founders have left the country that they're operating in. So it does actually serve us as investors and the local communities to keep these companies operating and well capitalized in the markets that they're in. What kinds of investment capital do local companies need? We'll talk about that today. And I know Fede's GDC team's gonna do a big presentation about the capital continuum. What are the creative financial instruments that we might use to better direct and better assess the risk return requirements of the investors that are interested in investing in these companies? Is it SAFEs? Is it convertible notes? Are there returnable grants that we could be using? Could we be doing local currency debt structures? Like these are all conversations that at Acumen we have quite a bit to try to tailor the capital that we have to meet the needs of the last mile distributors. And also, I think Nick alluded to this, but we see this too. There's a difference between using sort of a venture capital investment approach to scale a company and replicating a successful business model. Those are different approaches to investing, and they require different investment models. And so thinking through scale versus replication and where are we trying to do which. This slide is really long and detailed, but it illustrates some of the barriers that we see our companies in our portfolio facing, and some of the opportunities that we see. You know, we've already talked about the lack of access to financing, so we don't need to go there. Talent continues to be an issue, especially in really remote locations. And so that's something I'd be curious to hear folks discuss today. But also opportunities, right? You can create an entirely new market in a place where customers haven't had access to this product. You can optimize your operations. And I know GDC has been thinking a lot about how our last mile distribution companies using digitizing their operations to try to kind of make things more efficient. How can we get a little bit more advanced on how those partnerships between maybe manufacturers and last mile distributors retailing these products? Like, is there a way to make a better legal system so that those folks are set up to reach the customers that they need? And then just sales volume. And you can see that we have examples in our portfolio of companies that have struggled with each of these or address each of these opportunities. So I'm going to go to the next slide because I know I only have 5 minutes. On the capital continuum. This is an example from Acumen, but this is an example that I think many investors have. At the highest risk, you know, we invest equity, early stage equity in businesses. In this particular example, it's looking at productive use companies, okay? Moving up the line, we had an early stage investing initiative over the last 5 years that was looking at solar distributors in new markets. Still risky, but they were established companies or established models that they were replicating into these new markets. Now we're looking at this thing called hardest to reach, which is the next bubble up on the tool, and we'll talk about that in the discussion. This is a new instrument that we're trying to pilot to try to get companies that are established, have established models, to partner with local distributors, provide the capital that they need to grow and scale in their markets, and reach first-time access customers. And we'll continue, of course, to do our returnable capital funds, which is the final bubble there. But seeing that entire capital continuum is really, I think, what this industry needs as investors. We need to be working together to make sure that we're providing capital along the way so that companies, as they grow and scale, can see where they can get the capital that they need as they grow. So I'll stop there. I'm happy to participate in the rest of the conversation. Here's my contact information if anyone has any questions. And yeah, just thanks for having us. We're big fans of GDC too, so we're always happy to participate.
So hi everyone, it's my turn now. This is Federico Henriks. So the analysis of the capital continuum will start with a recap of last year's research piece of the GDC, introducing faster and slower growth LMDs. Then I will present what we understand by capital continuum and how we are mapping funders and their investment flows, where we see gaps in investment, what the challenges are for LMDs moving along the capital continuum. And we'll go through some of the existing and promising solutions to address these challenges. And most importantly, we'll hear directly from 3 GDC members sharing their experiences in fundraising along the capital continuum: Easy Solar, Divabits Green Energy, and Esmart. In last year's forum, we introduced the terminology of faster growth and slower growth LMDs based on their average growth in annual revenue, but then we also found a strong correlation with their strategies and fundraising. Faster growth LMDs make 7% of our membership. As they grow, their annual revenues have increased by more than $440,000 per year. They're typically focused on scale and quick geographic expansion, reaching large numbers of people, and have funded growth primarily with equity at all stages. Slower growth LMDs make the remaining 93% of our membership. They're typically focused on profitability and unit economics before scaling. They tend to work more locally with a strategy of going deeper in existing markets rather than wider across geographies. They have raised little equity. Most of them have funded company development with grants and growth with debt. And they tend to run leaner operations, having achieved 33% more revenue per dollar of capital raised. Also important to flag that it is within the slower growth LMDs that we see the highest share of locally owned and led companies. Needless to say, we see both faster and slower growth LMDs as being crucial to reach unserved customers. Last year, we concluded that fundraising challenges at the early stage are similar for all LMDs, faster growth and slower growth, and then vary depending on the growth trajectory. So during proof of concept and early operations, companies need early stage capital to invest in minimal viable infrastructure, a warehouse, transport, HR, etc., as well as a bit of working capital for inventory and consumer financing. The main barriers at this stage are startup capital and smaller working capital loans. LMDs following a faster growth trajectory, who are typically focused on quick geographic expansion, in theory need a balanced mix of equity to invest in distribution infrastructure and working capital to finance inventory and receivables. In reality, it is increasingly difficult to find equity investors. They have had to raise more equity than they would prefer, and growth is constrained by availability of working capital financing. LMDs following a slower growth trajectory, who are typically focused on sustainability before expansion, in theory need mostly working capital. In reality, access to loans is capped by their balance sheet. For those who missed our forum last year, I'll ask my colleagues to share the link of the report in the chat box so you can check it out. So to build on our analysis of last year, our mapping of the capital continuum will show 50 funders investing across the different growth stages of both faster and slower growth LMDs. And we are hoping that this mapping exercise will help LMDs navigate the funder landscape, encourage collaboration among funders, and point to gaps in funding. The research builds on in-depth interviews with both LMDs and funders investing directly in them, as well as data we extracted from our last membership survey and our funder database. Starting with how much money, how much capital has flowed into the sector, faster growth LMDs have collectively raised $120 million throughout their fundraising journeys. Only 9 of the 125 companies we assessed are in this category. These are companies like Altec in DRC, Yellow in Malawi and Uganda, and Sistema Bio operating globally. Their revenues are typically between $5 and $15 million per company per year. And the diagram is showing what these companies have raised collectively from proof of concept, like Altec winning a D-Prize grant 5 years ago, all the way to the Series B that was just raised by Sistema Bio earlier this year. In the case of slower growth, they have collectively raised $100 million to date. Most GDC members fall in this category as either early stage companies or slower growth LMDs further down the line with more track record. It's important to highlight that this categorization needs not be permanent. These LMDs may switch to a faster growth trajectory by adapting their strategy and raising capital accordingly. The diagram is showing what slower growth LMDs have raised at each stage of growth, with about 65 of our members on the right side of the screen having already passed their proof of concept and early operations and now continuing to grow their operations steadily. When comparing both, it turns out that faster growth LMDs have raised 16 times more capital per company than slower growth LMDs. But it's still important to highlight that collectively, early stage and slower growth LMDs are an important force and have raised almost half of the funding flowing into the sector. With regards to the mapping of funders, we have classified them based on their eligibility criteria and ticket sizes. The size of the bubbles that you will see up here is proportional to the number of funders within the sample of 50 that we assessed that are active at each stage of company growth. 16% of these funders, so 8 out of the 50, support LMDs at pre-seed stage. These 8 organizations include foundations, challenge funds, and accelerators funding pilots for companies to get their proof of concept, typically investing anywhere between $50,000 and $500,000 in the form of grants or convertible grants. We're placing D-Prize at this stage, and also the likes of Dune Foundation, who give special attention to initiatives in a pilot or starting stage. After that, where Dune works as a catalyst, they expect other funders to come in and take the baton. One clarification on format, the logos may be a bit too small for you to see. In that case, don't worry, because all of these will be in the form of a database with the information that you will be needing. So after the proof of concept is complete and some of the companies begin having revenues, we find 27 funders, such as foundations, impact investors, and crowd lenders providing, on the one hand, seed funding to fund market research, business model development, employee core team, invest in distribution infrastructure, and so on, typically in the form of grants, equity, or convertible notes. This includes, for example, the DRK Foundation providing patient capital and being often the first institutional investors, as well as first outside board members in the companies they invest in. On the other hand, companies providing some of the working capital these companies need at this early stage, typically in the form of debt, to fund their inventory and their receivables if they're providing credit. Some lenders like Beneficial Returns or Nexus for Development can come in this early with relatively small ticket sizes for viable early stage companies to achieve the next level of growth. Many of these funders have resources to support companies that are still relatively unsophisticated. And one clarification I wanted to make on the content is that we appreciate that these categories could use a lot more resolution. As Nick from D-Prize put it when we shared this the first time, there are several degrees removed from a seed investor like Acumen. It's not a single jump as shown in this diagram, but in this piece, we're trying to present the concept of the capital continuum with only a few categories, but we are planning on providing that resolution and unpacking these boxes that you see here as we make progress and we go forward. So for companies now pursuing that faster growth trajectory, we have identified 25 funders providing the equity and debt that companies need at around their Series A to optimize operations and scale. This includes earlier stage investors who reserved follow-on capital, like let's say Elia Foundation or Persistent, plus larger investors like Alpha Mundi's Alpha Giri Fund investing in emerging and established market leaders. As well as larger working capital facilities, we have lenders like Lend a Hand that at this stage will provide bigger tickets and will need a much higher level of sophistication of their borrowers to prove their repayment capacity. They'll have more stringent requirements regarding their balance sheets, revenues, and profitability than the lenders that come earlier on. And then we have 17 funders continuing to support companies to become market leaders and operate across markets through investments post Series A in the form of equity and debt. This includes, for example, the Kawisafi Fund that Sarah mentioned, launched by Acumen Partners for high growth companies in the off-grid energy sector, to more commercial investors like AXA investment managers that joined Kawi Safi in the Series B of Sistema Bio I just mentioned. Lenders at this stage, for instance, Sunfunder or the facility for energy inclusion, operate larger and more specialized working capital facilities with features that are attractive to last mile distributors, such as securitized receivables and currency hedging. For slower growth LMDs, we find much fewer funders. And remember, this is where most of our members are. In the mapping we did, only 11 funders provide financing that is suited to them, meaning the smaller working capital facilities that these companies need to run their operations and grow slowly but consistently. We see there is less emphasis on raising equity for these slower growth LMDs. Trends are positive though, as most of these funders, take for instance the Siemens Gasa Distributor Fund, Mithio or Charm, did not exist only 5 years ago. And new funds like Acumen's Hardest to Reach or Spark Plus Africa supporting last mile distribution are a clear indication that slower growth LMDs are gaining recognition for their work. These funders are coming up with clever ways to be able to reduce transaction costs and manage the risk of investing in these smaller deals. We will hear from some of them in the panel discussion that comes next. So borrowing from market intelligence of some of our key sectors, we're seeing very positive trends, such as the record capital raise in the off-grid solar sector of 450 million last year, an investment in clean cooking growing consistently at 20% year on year to around 100 million last year. But this is unfortunately a whole order of magnitude below the billions of dollars that are needed to achieve universal access. So it is clear that more capital is needed across the board. It is difficult for us to quantify the gap at each stage of company growth, but considering the big contrast that we're seeing between the proportion of slower growth LMDs that make 93% of our membership and the proportion of funders supporting them, 22% of those that we have mapped, we consider this investment gap to be more significant for slower growth LMDs. To experiment with the audience, we are throwing a poll question, but before you answer, make sure that you're only answering the one question that applies to you as either a funder or an LMD. Do not answer both. So can you please tell us at what stage of the capital continuum you see yourself as either a funder actively investing in LMDs at this stage or an LMD raising capital at this stage? We would like to see if there is a mismatch or not. So I will give a few seconds before I stop the poll and share the results. So I'm ending the poll and sharing the results with you. I think you may all see the pop-up screen. So what we are seeing is a dearth of funders investing in that slower growth category, just as we presented. And on the other hand, LMDs is not necessarily what I expected. I expected to see much more LMDs at that slower growth category, but still a substantial number of LMDs at early stage looking for seed funding and at their early growth stage. I'll continue with my presentation. So in addition to the overall need for capital, we find that across the capital continuum, LMDs have multiple valleys of death to cross, from pilot to early investment, and from there to capital to support faster growth or slower growth. And that they need to support that they need support to cross these valleys of death to eventually become important distributors, whether market leaders operating across geographies or local companies serving the hardest to reach populations. From pilot to early investment, what we have heard from investors is that capital raise for LMD innovators is more difficult than in other sectors, such as technology or manufacturing. And this we've heard from investors like the Dun Foundation that invest across different sectors. LMDs are unsophisticated, but early stage funders are willing to be hands-on. Take, for instance, CIMA, Angasa Distributor Fund, or Nithio that have used their own or external resources to support these companies get up to speed and be investable. LMDs at this early stage struggle to identify suitable funders. We've heard, for instance, from Trine, that's a big ticket lender, that 90% of the applications they receive are from pre-seed companies that cannot yet prove their repayment capacity. And when LMDs do identify the right funders, they're unable to communicate their market opportunity, the product, business plan, their team, etc., in the language of investors. We've heard that LMDs missing a solid pitch is the #1 pain point for funders investing at this stage. This is followed by financial literacy and data collection, which tends to be time consuming for both funders and LMDs, requiring multiple iterations. So what we've heard, examples of support funders have provided to bridge this gap are pre-seed funders like D-Prize and EEP. We've heard before that provide post-pilot finance to help these LMDs go further up the line and get closer to funders. Seed funders like Charm Impact that are trying to reach down to provide more hands-on support to early stage local companies than a typical lender would, drawing on resources like crowdpower to de-risk and keep costs down. And investment readiness facilities like the Finance Readiness Support Facility of GET.invest and Gogla's Elevate filling the gap in between. So now from early investment to faster growth, what we hear from funders is that strong unit economics are critical and that they are not necessarily linked to scale as previously assumed. Persistent paper last year said it clearly. The key determinant of profitability does not seem to be large scale, but rather the ability to run a lean operation and adjust your operating model to work in the local context. And we're seeing other investors like Acumen and Electrify echo this finding. In the meantime, we're seeing that faster growth LMDs that have pursued scale are struggling to raise the equity they need to keep that growth because of these delayed profitability and delayed exits of investors. In turn, this makes raising debt for working capital finance difficult, given lenders want to see a minimum amount of equity in their balance sheets. So we are seeing lenders that are starting to see a limited viable pipeline in last mile distribution, which they're competing for, so tend to end up switching to other more commercial segments. Key pain points that we've seen of funders at this stage are a bit more complex and varied. We've heard things like financial literacy, especially around valuation, the capacity of companies to produce financial statements, projections, to do reporting, and more generally, the capacity and degree of sophistication to define their strategies and run operations. Examples of support we're seeing funders provide are investors like Elia Foundation reserving follow-on capital to support companies move further up and continue their growth to commercial viability. Lenders like Sunfunder implementing debt structures that are more suited to LMDs, such as off-balance sheet debt. And funder groups like the Household Solar Funder Group, plugging the gap in between to facilitate discussion of the several challenges these companies are facing and promote specific solutions. And finally, from early investment to slower growth, what we've heard from funders is that slower growth LMDs typically have good unit economics. We will hear Nithio say that given that they typically don't have an equity cushion, they need to operate profitably to exist. They increasingly need working capital finance to grow operations and provide credit to their customers, but local commercial banks are not financing this segment. Only 1% of the debt financing going to LMDs came from local banks, according to our last piece of research. So there is a need for other instruments enabling the smaller ticket sizes these companies need. And finally, the key pain points we've heard from investors at this stage are also to do with the company's financial literacy and ability for financial planning. Things we're seeing funders are doing to support their companies are, for example, the CIMA and Angasa Distributor Fund providing these data-driven loans with lower transaction costs that allow them to look into smaller deals and continue to support companies as they grow. Spark Plus roping in product suppliers to de-risk lending for distributors, and programs like Aceli Africa or Green for Access First Loss Facility, providing incentives for local banks to come in and support these companies. We're seeing that there are quite a few access to finance solutions that already exist, but more are needed, including non-financial support. 3 key opportunities for interventions to help LMDs cross their valleys of death are improving collaboration and information exchange. This is among funders and between funders and LMDs to ease investments at all stages. And we see this, for instance, as being supporting investment readiness, especially targeted to the small and local LMDs, increasing visibility of LMDs, raising capital and supporting data sharing with funders, for example, through setting up an investment portal for LMDs, developing new data tools to help LMDs improve and showcase performance and investors to make decisions, and collaboration among funders through setting up an LMD funder alliance. Second, developing new or adapted debt financing mechanisms to free up more working capital for LMDs, such as unlocking debt finance from new sources, such as local banks and product suppliers, aggregating and de-risking debt investments to enable smaller ticket sizes, and receivables and inventory-backed financing for last-mile distributors. And last, leveraging results-based financing to improve unit economics and increase LMD's attractiveness to funders. And this could be carbon finance or other forms of RBF, offering social and environmental impact incentives. These 3 areas are far from exhaustive, but examples of concrete solutions that we can start getting our heads around in the final part of the forum. And before I conclude, we want to hear from 3 GDC members, as I said before. We'll first look at how Easy Solar, a faster growth LMD, has gone through the capital continuum since starting operations 6 years ago. Easy Solar is a leading distributor of pay-as-you-go off-grid solar products in Sierra Leone and Liberia, having reached 120,000 customers to date. So we'll hear from Alex Tour, the CEO of Easy Solar. Alex, over to you.
Sure. Thanks a lot, Federico. Thanks for having me. Hi, everyone. I'll dive in because I think we don't have like that much time. The reality of the job of CEO, I think, in that sector is that I've spent probably 50% of my time over the last 6 years fundraising. So there would be a lot of things to say, but I'll try to leave you with maybe 2 or 3 ideas, based on our experience. I think the first thing is, oftentimes there's a bit of a debate or a discussion as to like which stage is kind of like the most important, where should funders like really focus on. I think, it's been echoed a bit in some of the conversations here. But one interesting thing I realized when preparing for this session was that, when thinking about the funding continuum that we've had, we've raised like a significant amount of money. We've probably done 8 or 9 like rounds of funding, but not a single time did we have more than 1 term sheet on the table. Not once. Every single round of fundraising was take the money or die, or basically go into hibernation mode and die 6 months later, right? Every single one. So, and, we're a company that some would consider somewhat, successful. But I think, if it's true for us, I think it's true for a whole lot of other companies. And so I think every single stage is absolutely critical. And especially, I think, in countries that are considered as more difficult geographies, it's very dangerous to look at sort of averages, across the continent or across the whole spectrum, because the reality in some of those countries can be, I think, quite different. I think maybe the second idea is that, there's a lot of conversation around, how much capital is needed to achieve X, right? SDG 7, this goal, full access. But I think it's very relevant. But sometimes as, entrepreneurs and really living in this space, what I feel is part of the question is how many companies do we need to reach X, right? And how many fast growth companies? Not because fast growth is better than slow growth, but just because it's a numbers game at the end of the day. And so we are going to need companies that do scale if we really want to like achieve, SDG 7, full access to clean water and all this sort of stuff. And so when you think about this, how do you get more companies? Then there's a couple of questions that become very relevant. And the first one is, it's not just about getting from sort of pre-seed to growth, et cetera, if you will, from stage 1 to 2, 2 to 3, et cetera. It's also, how do you get people from stage 0 to stage 1, right? How do you get people who are thinking of getting into the entrepreneurship, business and getting them there? And, I mean, I'm not going to say this because Nick is on the call, but, what's the difference between sort of 3 students with an idea and a PowerPoint deck and 3 students with an idea, PowerPoint deck, and $20,000 in a bank account? That difference is D-Prize. And without it, EasySolve probably wouldn't exist today, right? Because we really, our example, was that we needed this initial capital to like show people that we were serious, to like demonstrate some sort of traction, gather data about the market. And without this little crazy organization that entrusted us with $20,000 when we had barely anything to show, we wouldn't have impacted, the 800 and something thousand, people that we have today. And the other reality that we faced, and this is more in terms of how do you get people from a slow growth to a fast growth phase, is I still remember as we were preparing for our Series Seed, looking at the list of potential investors, and I had like 2 names in there. Like we were lost. You're in the field in Sierra Leone, working on the day-to-day, working with your customers, your agents know this. And I think what was transformational for us was, the work of organizations like Gogla, like Power Africa, because I still remember getting on a call with the investment support team from Power Africa. And all of a sudden my investors list went from 2 names to 50. Right. And this was completely transformative. And we could have potentially stayed like a slow growth, company for a very long time if it wasn't for, those organizations, that sharing of information, that happened fairly early in the life of the company. And maybe the last idea to end also a bit of on a positive note, I guess, and I'm going to switch from sort of more early stage to sort of late stages. I think Federico, you mentioned a lot of interest and I think work that's being done on, improving access to inventory finance and in part, working potentially through manufacturers. And I think this is a really brilliant idea. And there's a bit of a disconnect at the moment in the market between lenders that are ready to lend to you sort of on a senior secured lending basis. But for this, you need to have built a portfolio of receivables yet, right? Especially for last mile distributors that are providing, funding to their clients. But you kind of need to start the pump, right? And there's 2 ways to start the pump. One is through equity. The other one is if you can have, more flexible sort of inventory finance. And I think, there's a lot of work to be done there, whether it's direct, funding or whether it's leveraging some of the key manufacturers for those, manufacturers to then provide sort of concessional terms. But I think this concept of continuing to sort of start the pump and allow companies to generate those receivables and then access the sort of massive pool of more senior secured, lending that is available is critical. There's a lot of initiatives going in that direction, and I think it's really wonderful. And I think just to finish on this, it's a missing link both for fast growth and for slower growth local companies as well. I think early inventory funding. Thank you.
Thanks a lot. And a lot of these issues we'll discuss in the breakout room. So looking forward to discussing more with you there. And now we're going to switch to an example of a slower growth company. We have David Wanjiao, founder and CEO of DivaBits Green Energy, representing, as I said, DivaBits, a distributor of pay-as-you-go off-grid solar products with presence in 8 counties of Kenya, reaching 27,000 customers in rural areas. David, and if you can be brief, that'd be super appreciated. We're running a bit out of time.
Thank you, Federico, and hi, everyone. My name is David Wanjiao, and I think I'll try to be brief in terms of our fundraising journey and in terms of accessing to, capital, And I think from my experience, and I would say, actually, gets a lot of entrepreneurs, especially in the last mile distribution, with a lot of surprises along the journey. And when you have the idea initially, and as Alex is saying, is that access to capital becomes your number one, barrier or, opportunity for growth or for even starting the idea. And I think for our case, we were very lucky, I think at the point that I was launching DivaBits Green Energy, that there was a competition from D-Prize. And, we tried our luck and we got the award. And it was still a very hard journey, even to convince the D-Prize team that we are in for it and we have a model that works. And, because we hadn't done, kind of distribution business before. And that was a tough one. And I would say that the D-Prize award also gave us an opportunity, and this is the most critical bit, it's to prove ourselves. So we kind of had a 3-month pilot, we were to distribute a certain set of products. And this was critical even for ourselves to actually, have confidence in what we think that we can do in terms of impact story, and also to the world. And that gave us an opportunity to prove ourselves. And we got lucky with a little bit of more grants, especially from UCDF, which was still a challenge fund that we won, and pitching our village solar entrepreneurs model and pay-as-you-go component. And I would say that these kind of early stage, for us, it was very hard to actually access debt. We even tried a little bit of commercial banks in Kenya, but it was very hard. So we got, like in fundraising more, looking for, grants opportunities where we could find them and trying to operate as lean as possible. First of all, to prove that we were profitable, because it was also very, we were getting a lot of other worrying news, hearing people in the solar industry that are struggling to be profitable. We didn't want to choose that path. And so we had to try and, become different and try to be profitable. And that was a really interesting part of our growth, and also trying to see how do you scale these lean operations. And so when it became profitable, we started thinking about it, like accessing grants, it's kind of like a luck thing, and we have a proven kind of like model is we need to start, looking for more investors. And, at that point, we couldn't get equity. So we started looking, who are the debt investors we can talk to? And even, getting to know who are the people in the industry is a very difficult one. So for ourselves, we had to align ourselves with some accelerator programs that can actually, one, make you more investor ready, and, prepare you in terms of what are these investors looking for, what kind of questions do they ask. And through these accelerator programs is when we had, chance to be connected with more investors, the likes of Kiva and others. And at least for Kiva came through for our case at that very early stage, which was very hard because a lot of investors we were speaking to, they were talking about, DivaBit has been surviving on grants. I'm like, yeah, that's what we could access initially, but we are profitable. Look at our numbers. And at least Kiva actually, looked at our numbers in detail and, kind of like believed in us and said, they can use this funding to become a catalyst for other investors to actually start seeing traction, especially in terms of credit worthiness, and actually building a credit history. So that was a really key first debt facility that we got from Kiva, and actually opened so many doors, because even for our case, as we were doing the due diligence process, it was kind of like a practical learning session, because we had gone through an accelerator program, but doing a practical due diligence is another thing. And that also made us a little bit better prepared to actually talk to more investors. And we actually got lucky now with the Simangaza coming in through, especially with the data-driven kind of like lending, because even the Kiva was very recent, so we didn't have a lot of kind of like repayment history. And I think with the Simangaza coming through, it also became much easier for us to access the Energy Accelerator Fund, and recently, social business, which is a little bit also aligned in terms of kind of like also leveraging what you call, secured loans a little bit, but also working in terms of our inventory and our receivables. So this is kind of like of our learning journey in terms of accessing capital. And we have also been very busy trying to access a lot of RBF grants to ensure that we survive. And what we're seeing is that the next phase, and which is kind of like we found ourselves in this slow growth path, is for us to actually grow fast and expand and accelerate our growth, is that we need now equity, kind of like funding. And there's a limit of how much debt funding we can access at any point. And therefore, we're starting to think about beyond what we are doing in terms of working capital. There's more that comes into us scaling operations. And that's where we need a strategic equity investor coming in. And that also opens more doors for us to actually be able to access more debt and grow our impact. I think I'll stop at that, and so that we can have more people talk. Thank you so much.
Thanks a lot, David. And finally, like with all things, it's not all black or white. We do not want to put all of our members into boxes, but introduce concepts that are useful to show trends and gaps in the sector. And SMart is a company that we cannot fit in either of the categories we presented. It combines elements of both. So we'll invite Jackie Stenson, Executive Chair of SMart, to provide her insights. SMart is a distributor of livelihood products operating through a network of 4,600 plus shops in India, having sold over 260,000 products to date, impacting over 1 million people. So Jackie, over to you.
Thank you, Fede. Hi, everyone. So I feel like the sentence of could not fit cleanly into any one box probably just describes like my life in general and my personality, and also SMart. So I think that there's maybe a few factors here that have affected this. The first is that we're old. SMart is, like, I've been doing this for a long time, well before this sector was sort of even really called a sector. And so that has influenced our need to focus on unit economics, a trend that you see in the slower growth ventures. The second difference is that we sell through shops versus agents. And what that means is that the way that we do working capital is very different. So we don't have as many working capital requirements, which means we don't actually need the working capital to the same extent as many of the slower growth ventures do, and we raise more equity. And the third is we are technology agnostic and have been adamantly since the beginning. And that means that a lot of our products are actually across agriculture, clean cooking. We have solar, but it's not the largest part of our portfolio. So we have a bunch of products that don't lend themselves to pay-go. So that also means the combination of the shop model plus the product mix means that we don't do consumer financing to the same degree. We do retailer financing maximum like 90 days. So that has affected, I think, our growth story over the last several years. And what that's meant is our fundraising journey has changed, because when we first started, funders were really, really skeptical of the last mile distribution space. And there was a strong need to focus on unit economics. But there was a strong need for us to raise equity and to be able to grow faster. So we focused on unit economics, but also modularity and scalability and the technology behind that. And so that's meant that we haven't really fit cleanly into some of these pictures. But our growth journey has therefore very much so been stepwise. So we often scale fast, like doubling or tripling, and then we pause and we refine and we reposition and we improve, and then we raise money and we scale fast, and then we pause and we refine. And so that's kind of been our journey a little bit. And so for us, it's really been important as we go on this journey to find the right funders, specifically those who don't really put us into a particular box. So I guess third shout out of the day to D-Prize for basically eliminating some of those barriers. But that's also meant that when we find funders, we're finding funders who contribute expertise to one aspect of our model. Because we're sector agnostic, because we work through shop owners, you don't find all of that in one place. And I think that that's really important, because as funders look to sort of help scale us up, we end up trying to copy and paste what happens in Silicon Valley. And it is a numbers game, as Alex says, but as a numbers game, we need to propel a lot more of those slow growth enterprises to the fast growth enterprises. And that means not necessarily fitting everybody into one particular box. So being open to say, well, actually, one of our investors is really, really great at working with shop owners. And one of our investors is really, really great at working with agriculture, or however that might be. We kind of piece together that expertise. So not every funder needs to be an expert in absolutely everything. We've also been, I think, fortunate in that we've leveraged our position in this ecosystem and to be sort of sector agnostic to create a more resilient value chain for, in our case, livelihood products. So some of our funding has come from not the most typical sources. We absorbed 1 Acre Fund's India operations, extended our model from B to B to C, and 1 Acre Fund invested in us to extend our model and our product portfolio. So we've been able to sort of build this ecosystem of funders and partners that have been able to support us on our journey. And we've sort of like bounced around between these two lines where modularity and unit economics is important. But I think, as David said, we're in the, like, you at any point you can push the button on scale. And the question is, how much do you want to scale confidently, and how much do you want to scale while bleeding money? And like, I don't feel comfortable scaling while bleeding money. That's something I'm terrified of, and so are some of our investors. So designing around scale and what does that mean, and how do you actually support enterprises to scale efficiently is, I think, something that's really important in facilitating this whole continuum, and doing so in a way that we can make sure that we're crossing the boundaries between some of these trajectories, and therefore getting this numbers that you actually need to achieve success. So that's, I guess, a little bit on our journey.
Great, thank you very much for that. And now I'll wrap up as quickly as possible, so we go back to being in track. Just summarize key conclusions of what we've just said. 7% of LMDs that are faster growth have raised 55% of the total investment into the sector to date, which is 16 times more investment per company for faster growth than slower growth LMDs. Slower growth LMDs, in spite of less funding raised per company, are a strong force that have collectively raised almost half of the capital flowing into the sector and translated that into sales that are 33% higher per dollar of capital raised. We're seeing positive investment trends with record investment in off-grid solar, investment in clean cooking also growing. But this is far more capital is needed to achieve universal access. We're seeing 2 times more needed in off-grid solar, 40 times more needed in clean cooking. So the gap is clear across the board, but we're seeing the gap in investments may be more critical for the slower growth LMDs, considering the very few funders that are investing in them. LMDs face multiple valleys of death across the continuum, with support most needed in 3 areas: improved collaboration and information exchange, new or adapted debt mechanisms, and leveraging results-based finance. With this, I'll end my part and hand over back to Emma. Thank you.
Thanks, Fede. And thank you very much to Alex and David and Jackie. So we hope this presentation was useful and interesting. So for GDC members on the call, the goal is to help you navigate the funding landscape. You know, Alex, you were talking about some of the challenges that you had with identifying funders at different stages. So hopefully this sheds some light on what funders you should be talking to at which stage of growth. And for the funders on the call, we hope that this is a springboard for you to reach out across the capital continuum to collaborate with other funders. And we hope that it clarifies where the biggest gaps and the biggest opportunities are for you to support distributors moving forward. So if you'd like to discuss anything more about this capital continuum research, then please do reach out. And I would also encourage you to visit our funder database, which is still a work in progress, but it contains a pretty substantial number of funders operating along the continuum. So you can find it under the resources tab of our website. You can filter by sector, geography, type of capital, and ticket size. And if you know of any funders that are missing from this list that you know have invested in last mile distribution, we're only including investors who have a track record of investing in these companies, then please let us know and we will add them to our database. So we're now going to move into part 2 of the forum, after which we promise we will have a break. So part 2 of the forum is our panel discussion. And this panel discussion is all about innovative financing models for last mile distributors across the capital continuum and lessons learned. So I'm going to pass over to Divya Balakrishnan, who is an advisor for mobilising renewable energy investments at GET.invest. And she's going to be leading this discussion, introducing the speakers and acting as moderator. So over to you, Divya.
Thank you, Emma. I would actually like to start with a quick introduction to GET.invest itself. So the audience here knows who we are and also feels comfortable enough to reach out to us. So GET.invest is a European program that mobilizes investments in decentralized renewable energy. They are being implemented by the GIZ. The program is supported by the European Union, Germany, Sweden, the Netherlands, and Austria. We are also currently piloting the Team Europe one-stop shop for green energy investments in Africa. It's as part of the Team Europe Africa EU Green Energy Initiative, and it's powered by us. Our core service, which many of you here have probably heard of, is the GET.invest Finance Catalyst, which links clean energy projects and companies with finance, targeting small and medium-scale renewable energy opportunities currently in Sub-Saharan Africa, the Caribbean, and the Pacific region, with 25 seasoned experts in our pool. Some of them who are here in this call, so please feel free to drop a quick message in the chat so they will reach out to you. I think this is specific also to Stuart Crane, who mentioned in the chat here that there's a lack of activity in the Pacific, so perhaps we can support you on this. Moving forward, could you please change this slide, Federico? Thank you. From our extensive experience via GET.invest Finance Catalyst, our older and more established service, as well as extensive stakeholder consultations with, for instance, at GDC, GOGLA, RA, Clean Cooking Alliance, Acumen, Heroes, quite a few of them, we realized that early stage, locally owned and managed companies require very specific, in-depth, long-term advisory support to reach scale. A lot of what I've just mentioned has already been explained in detail about this capital continuum gap, etc. And this is exactly what we are trying to address. Like Mariama Kamara also mentioned here in the chat, there is a lack of investments into locally owned companies. And Mariama, you might be pleased to know that this is exactly why the new service of GET.invest was launched. So what do we actually do is that the service works towards enhancing the capacities of locally owned and managed companies. And what do I mean by this? These are the younger, earlier stage companies, specifically, who have a minimum of 50% local ownership at least. And what we do is we custom make long-term advisory with them. It could be literally anything that they need. Setting up accounts, financial controlling, IT infrastructure, policies, operations, whatever it might be, whatever it takes for these companies to sustainably absorb finance. And we additionally also prepare them for investment and how to face investors. How do you pitch yourself? What is the language you use? What do investors look for? And we also introduce these companies to investors. So this is the additional access to finance advisory, and all of this advisory is a part of the finance readiness support. As of today, we have already the first cohort. There are 15 advisees, but additionally, we are going to have a new cohort by the end of August. So we will be, by that time, supporting up to 32 of these companies. And inshallah, may there be many more. I would like to now move on to the panel discussion. Thank you, Federico. I'd like to begin by introducing Kia Mukundan here. She's the project manager for performance and investment at GOGLA, and she coordinates the Elevate Investments Readiness Support Program that provides technical assistance to early stage off-grid solar companies in raising external capital for the first time in most cases. Kia, over to you.
Awesome. Thanks so much, Divya. Really nice to be here. I think it's actually super that we start with Elevate, as we really do focus on that early operations group of companies on the capital continuum that Fede presented earlier. So like Divya, you mentioned, we are a pilot investment readiness program, and we are complemented and funded and supported by the GET.invest FRS program. And this is actually the first project that GOGLA is working on that is specifically focusing on locally owned companies. So it's been really great to be coordinating this project. The goal of Elevate really is to enhance investor readiness, and the impact we really want to see is increased investment. So of course, the focus is really on technical assistance, but we hope that what we see after the project is that these companies manage to build those connections with international investors, and we can also start this conversation on locally owned solar companies and what the barriers are to investment. A little bit on the cohort itself. So we received over 70 applications for the first cohort, and out of the 20, actually 14 are distributors. So I think this really shows the strong overlap that we have on the work that GDC is doing. And it's been really great to collaborate with them on the insights and learnings that they've also drawn from their membership. And I think it also shows the focus and the strength that local companies have when it comes to distribution. And so just shortly, what Elevate provides to this cohort, we really focus on two main components. So the first aspect is technical assistance to really boost investment readiness as based on the needs of the company. So this means tailored trainings, using existing tools. COCLA already has some in place as well, such as the Consumer Protection Code, the Investment Academy, so making sure the companies have access to these. And then the second part is really to do with linking companies to international investors, different types of events and platforms, and tier providers, and making sure that we build those relationships through the COCLA membership and through attending forums like this. So that's just shortly what we're trying to achieve through Elevate.
Great, thank you so much, Kia. I'd also like to take this opportunity to encourage the audience to please post your questions in the chat. I will ensure that they get addressed by the right panelists post all of their introductions. Kia, before I move over to the next panelist, I just had a quick question for you about Elevate. Could you probably share a bit of the general challenges that you've gathered from your interactions with the companies on the Elevate cohort?
Yeah, I'm happy to. So we did conduct a needs assessment after we selected the companies, and we found out that 2/3 of them are not really aware of the main funding cycle steps, and only 6% of them said that they feel really experienced in fundraising and have successfully secured the type of funding they need for their company. And again, I think this was also mentioned before, the main challenges that they mentioned were really to do with the lack of access to international networks and finding suitable investors for their needs. And then the second part was more to do with lack of time and resources to really match the requirements that the investors have and having that financial literacy. So the due diligence processes were specifically mentioned as something that the companies have been struggling with. So yeah, we really hope that through these trainings and tools, we can put in place some of those documents and make sure that the companies, when they pitch to investors, they have all the documents in the data room, the pitching in place to be able to raise funds.
Great, thank you. I also see we have a question or two from the chat that's interesting. Mariama would like to know when the next cohort for the Elevate program is going to be. And also I see Merdad would like to know more of the registration for the next cohort for Elevate. So would you like to address this already?
Yeah, so as I mentioned, we're a pilot. So we're really using this as an opportunity to learn from the first cohort. And I'm hoping if the results and the impact that we find from this are useful, then we will be opening another round. But for now, we don't yet have a date in place for that. But I will put my contact also there. So in case you're interested in Elevate or any of the other tools we have, I'm still able to connect you to other relevant sources for now.
Perfect, thanks, Kia. I'd like to next introduce Lorraine Indangasi, the head of investments at Charm Impact. Lorraine will tell us more about Charm's track record of lending to local LMDs to meet their working capital needs during early operations. Lorraine, please take the floor.
Thank you, Divya. Hello, everyone. I'm very happy to be here. Interesting discussion so far. To introduce Charm, so we're an investment platform and we provide small-scale debt financing to early-stage entrepreneurs, specifically in sub-Saharan Africa. Our ticket sizes are about 10 to 250K. But a bit higher for repeat borrowers. It's something we've actually observed where I guess when we started out, we thought that we would be setting the stage for more or larger funders, but in many cases, a lot of our entrepreneurs in lacking capital elsewhere come back to us. We lend typically to local entrepreneurs. So far with the 1.5 million pounds we've disbursed, 99% of that has gone to local companies and 38% of that to women-owned or led companies. I'm not sure whether it's probably clear being that it's the platform that we're on, but we lend mainly to clean energy and clean cooking entrepreneurs operating in mainly rural, harder to reach areas. And what we see is that a lot of these early stage entrepreneurs are financially excluded from traditional forms of debt financing. It may be due to lack of collateral or just as it has been mentioned before, very few commercial funding entities or commercial banks have models to look at these companies. So many times they don't have access to the traditional forms of funding most other companies would have. Maybe to go or the lessons that we've learned so far in working with these entrepreneurs. I would say mainly there's a bit of a challenge in terms of the quality of data or the quality of the documents that we receive. So sometimes, and this is part of, I guess, our value add, we have to dig into the companies a bit more just to translate some of the information they have in a way that can be understood better for us as investors. So like with the management accounts or with the forecasts, we find, or rather we've created models to enable us to understand this data better, even when it's not presented in a way that quote unquote is investor ready. Another challenge that we have, seeing that we provide blended financing, the philanthropic part of our capital kind of takes the place of the collateral. So all our lending is unsecured. We've had a bit of challenges raising first loss capital. And that's just an area we continue to focus on so that we can continue to lend to locally and local entrepreneurs, and especially also women led and owned companies. I would say so far we're really pleased with our results. We're in the election period in Kenya, so if you can hear a campaign vehicle moving, that's the reason. So far we've had quite positive results. We've not had any defaults yet, and we have so far been able to get 5 of our loans repaid out of the 24 projects that we've done. And we continue to just look for de-risking mechanisms to catalyze a lot of these clean energy entrepreneurs and clean cooking companies in sub-Saharan Africa.
Great, thank you, Lorraine. I have a quick question for you. I understood from what you said that quite a few of your companies come back to you for second or third loans. So this probably kind of reflects like an established credit history in a sense. Yeah. So I'm wondering if there are examples of companies that have benefited from this established credit history as a result of you lending to them.
Yeah, we actually have a number that have been able to then raise more commercial funding after us, and some even go on to raise equity. One of the things I'd like to also mention here is we try and have a very comprehensive credit assessment. So we explain to the entrepreneurs the different aspects of the business that we look at, so that when they're also going into improving their business models, they know where to focus on. So for instance, there'll be qualitative aspects or more financial leaning ratios where we'll be able to explain to them that these are maybe red flags they should look at. So even in saying that we're providing a credit history, it's also a very detailed credit history. And I think that not only enables them to be better prepared for larger investors or larger ticket sizes, but also be able to explain their business models more and understand where maybe the pitfalls of their businesses might be.
Fantastic. Sounds very promising for companies that need specifically support in the whole credit history topic. Thank you, Lorraine. I'd like to now move on to Kate Steele. Kate Steele is the co-founder and COO of Nitio. And she explains the role of digitalization in understanding risk and scaling finance in the LMD sector as companies grow. Kate, over to you.
Thanks, and everyone, nice to be here and nice to be with this cohort. So we saw a gap in the market for scalable financing across the board, and especially for these smaller companies. And we felt like one of the things that was lacking in the space was an ability to really understand consumer credit risk, household credit risk for those who are purchasing pay-as-you-go products, and therefore really difficult for any size company to understand their cash flows, which is an acute need at the larger scale companies, but especially for the really small ones to be able to understand how money is coming back to you. So we developed a credit risk assessment model, uses geospatial data, consumer payment data, AI financial modeling that allows us to better understand those receivables and the cash expected from them, and allows us to offer receivable-backed financing to companies really of all sizes. We go down to smallest ticket size we're contemplating right now is 200,000. 500,000 is probably a bit better fit for us, but we have looked at smaller scale. But we really want this to be something that can help companies scale. Of the 4 loans we've done to LMDs so far, 2 of them we've already upsized, and 1 of them we're also contemplating upsizing it. So we do intend for this to be something where people continuously come back to us for larger and larger pools of capital as they continue to grow their businesses. But we also see this as something that helps other investors. I don't know if everyone saw, but Peter made a joke in the chat about the Elevate title. The slide title had investor readiness and the need to educate investors as well. And I think that's really true. I think a lot of investors looking at this space, you don't know how many times I've been asked, well, aren't the smaller companies more risky? And I really don't think that's the case for a lot of them. But also just helping them understand how they can invest in this space and what's actually needed to be there. So the things that I'll just jump directly to the challenges and lessons learned. Yes, it is challenging to lend to smaller companies. You spend a lot of time doing due diligence. We run into the same challenges that Charm does as far as what's needed to make sure all documentation is in proper form. Financial model is something that can be easily assessed. We use a lot of TA resources for that. We have to get additional TA resources from our investors or from other sources to be able to do that. However, I think all of that is putting them more on the path to have that investor investment readiness, which will allow them to tap into larger pools of capital. But we have found that is really reassuring is that small companies tend to have good unit economics. There's been great discussion in the chat about how you get to that point of having really good unit economics and what you focus on. And I think we found that from the beginning, in part because there has been a lack of equity, that a lot of these companies, if they're actually around 2 or 3 years later, they probably are financially viable because they don't have a large cushion of equity that they're falling back on. And we've also found, just as everyone knows, they've much better reach into remote rural areas. So if you're really looking to have that impact, then that is something that you want to be working with these smaller companies. They're going to be be able to reach those communities much more easily. And I think this is, maybe I'll close on point for the investor piece of it. I think this is something that really, as a larger investor community, we really need to think about is if we're going to go into these remote rural areas, if we want to have the impact in terms of reaching last mile, it's going to take those TA resources. It's going to take more concessional capital. That the idea that a lot of these households will be reached by a fully commercial solution, I think is a bit unrealistic. And so I think that's one of the pieces we've tried to bring with this data-driven assessment is understanding of the market as a whole, the pieces that are commercial, the pieces that are probably semi-commercial, and the places that will probably need to be reached by a much more supported solution. So I'll close with that, but I'm happy to answer any questions.
Thanks, Kate. We do indeed have some interesting questions pouring in, and I can already direct one of them to you. From the investors in this session, is there anyone who has investment experience in Ethiopian companies? And if so, please share your success experience. if it applies to you, or I could also address it to Peter later on.
Yes, I'm not sure I followed the investors in Nithio.
In Ethiopian companies.
Oh, Ethiopian, sorry. We have a challenge with Ethiopia because of getting currency out of Ethiopia. That's been our main challenge there, is the investment environment overall. It's not specific to the energy sector.
Thanks. I have another question for you. So are there any specific trends or concerns to enabling finance, specifically for LMDs, over the last year or two that you've observed that you might want to share here?
I mean, I think it's a bit the challenge that we've seen of where everyone wants to be, but also being realistic about what it's going to take to get there. I think that's the point about people do want to invest in LMDs, and we've had discussions with Charm about this as well, and with some of the other people trying to serve the really last mile companies. A lot of investors talk about wanting to do that, but are not willing to put in the concessional capital or the TA resources that are truly needed to reach that. I think there is a lot of interest in the larger companies, and I think that's pulling a lot of the capital away from the last mile distributors, in part because it is really hard. So I think that's a trend. Yeah, there was a bit less consolidation in the Google numbers that came out this year, but I think that trend is not reversing. I think we'll continue to see most of the capital concentrated on the higher end of the market until we can make sure the investors really see what the opportunity is here.
More questions pouring in here for you, Kate. I'm sorry, I didn't get the name right. Rekik Bekele would like to know, where is Nithio focused?
Across Africa. So we initially started in offering loans in Nigeria, Kenya, and Uganda, but we're open across the continent at this point.
Okay. So going forward, do you expect to continue providing finance for companies across the capital continuum, from large to small and vice versa? Or how are you planning on dealing with the additional resources for these needs?
It's a great question, because I think that's actually where we saw an opportunity, was a lot of the investors that have been in the residential side moving into more C&I. I think that opens up a lot of space for Nithio, and we really are committed to working across the full spectrum. But I do think we have to be realistic about the extra resources that are needed. So we continue to actively fundraise, as someone else said earlier, like most of the job is fundraising, but making sure we always have those grant resources, always looking for catalytic capital in our blended finance facility, always looking for the additional partners that we can work with, like GET.invest, like Power Africa, to make sure we can have that support to smaller companies so that we are able to continue lending in that space.
Divya, you're on mute.
Sorry, thank you. Doesn't help if I'm speaking to myself here, of course. But yeah, thank you, Kate. I will now move on to Peter, and then we have more questions for Nithio, but we will get back to it post Peter's presentation. So we have Peter George, who's the co-investment director of Spark Plus Africa Fund. Peter will be talking about the recent launch of the first impact fund investing in cooking energy solutions, the more established companies across the value chain, as well as distribution partners. Peter, over to you.
Great, thank you very much, Divya. Great to be with all of you, and thanks so much to the organizing team and GDC for the invitation to participate. So I'm Peter George, and for those that I've not met, just 30 seconds on me. I'm based here in Amsterdam, and I've spent about 16 years in energy finance, both in advisory and principal investing. The last 6 years, I've been with the Clean Cooking Alliance as their senior director, overseeing the investment grant and TA programs that CCA has implemented. And prior to that, spent another 6 years in electricity access, advising grid-connected, mini-grid, and off-grid IPPs. I started my career on Wall Street in investment banking in the energy group at Merrill Lynch, and then at a private equity firm investing in energy assets of various types, including utility scale renewables. And transitioning away from developed markets and into the developing markets, into Africa back 12 years ago, I think it was very sort of clear from day one, but it's been sort of hammered in ever since, the importance of business model innovation and last mile distribution models, consumer finance models, as kind of the unsexy but really critical part of the equation. The two big challenges are delivering products or services which are affordable to consumers, and secondly, it's doing it profitably. So it's clear to me that there should really be a focus on the business model as much as the product or service itself. And I've been really delighted to support the great mission of GDC. Serving as a member of the first steering committee, and it's great to be part of the discussion here. So we're essentially, I'm representing our team, which has recently launched a fund called Spark Plus. Our team is sort of geographically spread between Switzerland, Nairobi, the US, and elsewhere. But Spark Plus is essentially a collaboration between a consortium of partners led by a Swiss impact investment advisory firm called Enabling Capital. Also, the Clean Cooking Alliance, where I originally came from, is sort of a part of the group that got this fund off the ground. It's now sort of a separate partner to the fund as a sort of TA provider to the pipeline and portfolio companies that Spark Plus is focused on. But we're working very closely both from a TA perspective and also kind of at a sector level, since DCA plays such a big role in sort of sector level issues around clean cooking. So Spark Plus is basically a $70 million impact fund, making up to $7 million investments across the value chains of really any kind of clean cooking solution. The primary ones being LPG, ethanol, biogas, improved kind of efficiency biomass stoves, electric appliances, and there are other sort of technologies on the horizon as well, but those are the sort of key areas that we're investing in. It's a blended capital facility, and our investors include African Development Bank, the Danish and Belgian DFIs, IFU and Bio, as well as family offices, foundations, and pension funds. We're investing primarily through debt instruments. They can be short or long tenor. They can be senior and secured by collateral, or they can be subordinated and unsecured, sort of quasi-equity that has more of an equity-like risk profile. We can finance inventory, working capital, receivables. We can provide general growth capital. So we have a lot of flexibility in how we structure our investments. And while, of course, many companies in our pipeline are product designers or manufacturers of products, we really are very much focused on looking to provide that much needed financing to LMDs and companies specifically engaged in last mile distribution, some of whom work with one product supplier, some work with multiple product suppliers. So this can involve, as I think was mentioned on an earlier slide, this can involve a tripartite financing arrangement where we essentially share some level of risk with the product company in order for us to be able to lend to their distribution partners, who would otherwise be too small, not particularly bankable, or for whom we would end up underwriting at a relatively high cost of capital. So the pricing would be less attractive, but by sharing some of the risk with the product company, we're able to bring that pricing down somewhat. This could involve, for instance, us working with a distributor and their supplier of LPG cylinders, cook stoves, biogas digesters, or other products, and can also allow us to finance companies that starting at a smaller ticket size than we typically target. I think Kate just mentioned they typically target 3 to 500. And that's really the range that we can sort of come down to, particularly in this kind of tripartite arrangement. Otherwise, we would ideally be looking for kind of $1 million plus, obviously given a fund size of 70 million. So just to wrap up, we launched the fund in March this year. We've already closed 2 transactions, one that we announced with Burn Manufacturing just I think a week ago, and another with a microfinance institution in Kenya called Sumac. And we're really interested in engaging with any of you, any companies in the last mile distribution space that are marketing products related to clean cooking. And you can find more information about our fund and also the ability to contact us through a contact form on our website, which is sparkafricafund.com. I think that is it for me. So thanks very much.
Thank you, Peter. I have a quick question for you based on what you've just presented to. So most members of the GDC focused on distribution may not qualify for Spark Plus and the tickets you offer. Have you encountered challenges in therefore financing LMDs? And if so, how do you go around it? What solutions do you have to implement finance for distributors?
Well, I think we're definitely, motivated to try to address, whatever challenges prevent us from, investing in LMDs and other companies in our, in the different segments of our pipeline. I think that different challenges include kind of the track record of the company. Some companies are relatively early stage. Some of it is around the balance sheet. One of the previous panelists was talking about the equity cushion that, may be very limited for many last mile distributors, which can also be viewed as a good thing because they're not burning through equity and kind of, they're having to prove themselves as sustainable kind of earlier on. But, as a lender, obviously that's a challenge because you want to see that you're lending on top of an equity cushion to some degree. So I think I would say our advantage is that we're able to be quite flexible in how we structure our investments. We have a mandate which is not unlimited in its flexibility, but is pretty, pretty flexible. And so we can really look at things on a very case-by-case basis.
Perfect, thank you. I'm going to now open this up a little more to the broader panel for a potential discussion, if I may call it that. But I will continue with you, Peter. This question would also be relevant to you. How can a collective like GDC, or what can a collective like GDC do to advance access to finance in the sector? Is there a specific way GDC can also support you in specific to the new fund that you've described, or even generally? If you have ideas, very happy to hear them now.
No, it's a great question, Divya. I mean, I think so. We've wrestled with that question in the context of CCA over the last several years. Because on one hand, kind of what's needed are more investable companies, but there are other, and that's something that is organic and is not necessarily something that a third party kind of industry association or champion like the GDC of the space can kind of make happen as much as it would like to. I think information is a big one. I think having information around the performance of companies in the space, thinking about KPIs, trying to get investors and potential investees on the same page around kind of what are the KPIs that are important to be achieving, and creating some level of transparency within the space. The Clean Cooking Alliance has written something called the Industry Snapshot the last several years. GDC writes a similar kind of state of the sector report, which is great. So I think those are all important. Convening, I think, is another aspect of it. So hosting things like this, and in-person events hopefully is another way in which you can address some of the challenges. But yeah, those are a couple of thoughts.
Thanks, Peter. A few bright thoughts there, in fact. Kia, I would like to move on to you, also in a sense of we're coming to the end of the session soon. So if you would like specific closing remarks, please feel free to add them in. But more specifically, what other issues do you think could be tackled with collaboration? And also, what may be limitations of collaboration?
I mean, I'm kind of echoing what Peter also said. As an industry association, there's always so much you can do. Of course, you can share about the performance of the industry, share tools, you can convene. And I think this is a very good place for that. I'm really looking forward to the COCLA Forum in October. And we're hoping to do a really local company focused side session there. And referring back to the earlier comment on also educating investors. So really having an open dialogue between companies and investors and what are the barriers and trying to get that dialogue going. So I think a lot can be achieved through that. But then of course, at the end of the day, it comes down to actions, right? So after we move on from the conversation, making sure that we come out from these forums and actually we get more investment into the local companies. So yeah.
Thanks, Kia. Thank you. Moving on, Kate, Lorraine, either of you could respond to this, or maybe both, but also this is also the moment to kind of wrap up the session in a sense. So very specifically, what has allowed you to make smaller ticket sizes happen? That's very relevant to distributors, to LMDs here too. What more is needed? And yeah, and how can GDC further support you?
I can go first. I think one of the things that at Charm we keep trying to do and keep trying to question ourselves on is what are we missing when it comes to the smaller companies. So we recently had a conversation, in fact, about not just companies being investor ready, but even we as investors being company ready. And one of the things that I think has around that question that has enabled us to keep looking at smaller ticket sizes is how can we question our analysis more? How can we make it more tailor-made to smaller LMDs and smaller companies that have not yet reached the scale that would be ideal? Like one of the things that has come up in the discussion was how strong your balance sheet is. But if we try and think about what could be the replacements for a strong balance sheet that could still give us the information that a company would be able to service their debts. And I think just kind of piggybacking onto Peter's point in terms of how the GDC can come in, I think one of the things that I'd like to emphasize or re-emphasize is the KPIs. I think if us as investors are more transparent in terms of what we look at, and so for instance, the investor database that you're creating, if we could put in more information for companies to easier understand what would disqualify them and how they can just go back and prepare before they come to investors so that it's more efficient or no one is wasting time, I think that would help. And just forums like this where investors also speak about how the challenges they face and how we can address them. I think it's in the long run, companies start to understand more and more what kind of capital they need and what kind of information they need to share for the specific capital they're looking for.
Right. Thank you so much, Lorraine. Some very important points you've raised out there. Kate, I would invite you to share your thoughts, your last words on this.
Thank you. I'll quickly wrap up. So some of the things we're trying to do to continue working with smaller companies is automate more of our lending processes. Part of that on the data assessment we do on the portfolio, as well as even just onboarding of all information. I think this is nothing specific to energy, nothing specific even to kind of last mile. But if you're going to make a lot of small loans as opposed to a few big loans, the more automation you can work into that process, the better. And I think we're well positioned to do that. As far as what would be needed from GDC, this is very, very practical, but the more templates of what's going to be expected and maybe what's going to be expected at different stages, that I think companies get to the point of talking with international investors and may not have an environmental social management policy, may not have a anti-money laundering policy, may not have anti-child trafficking policy. Like a lot of those are things that there could be pretty readily available templates for, and maybe there are through different pieces. But I think some of those, as well as just knowing what's going to be expected in the financial model, kind of what format works best or what metrics you're going to be likely to need to show. I think a little bit more of that kind of early stage, not even necessarily doing the work to help the companies get there, but just letting them know what the expectations are and maybe providing some of that guidance would be really helpful.
Fantastic. Some very, very tangible points out there. Thank you very much. I'd like to thank each of the panel members and also invite you to respond to the questions that were directed to you. I will share them with you over chat. Please address them in the larger group. Over to Emma, just keeping with the time here.
Thank you. Thank you so much, Divya, for moderating and sharing more about GET.invest.
So nice to see you.
Oh. Also, Divya, I wasn't expecting you to grill all the speakers about what more the GDC can be doing in this space. So thanks for that. I feel like our plates are a little bit fuller for the next 12 months. So thank you. And thank you so much to the speakers. It's so brilliant to see these initiatives come to life and fill what have historically been quite large gaps in the sector. And I think we at the GDC are quite inspired by what Spark Plus is doing, because 5 years ago, if you talked about a dedicated investment fund for clean cooking, people would have just thought it was totally impossible. And increasingly, it feels like something like this, a dedicated fund for last mile distribution, could be a reality in our sector. So that's something that we are particularly inspired by. So we are 2 parts down in our forum, and we're shortly going to be splitting up into breakout groups. But before we do that, I think we're going to pause for just 10 minutes. We're going to launch a quick poll just to so you can let us know how you found the first 2 parts of the forum. We're keen to get your feedback on how useful this has been. We're going to come back together at 5 minutes past 3. So that's in exactly 10 minutes time, at which point you'll be choosing your breakout groups and we'll be going into a much more interactive conversation. While we pause, we're very excited to share with you a little taster of our brand new 3-part video series, which has been supported by UK Aid. The video series is called Investing in Last Mile Distribution, Stories of Growth and Impact. And it features 3 GDC members and the financial intermediaries who've invested in them at different stages of their journeys. And I think this really brings to life some of the discussions that we've had so far today. So we hope you enjoy this video for the next 5 minutes, and we'll come back together, as I say, in exactly 10 minutes at 5 past 3. That's UK time. So thank you, everyone, and we'll see you soon.
Crucial role in driving demand for life-changing products and delivering these products to the hardest to reach consumers. Access to finance consistently tops the list of challenges last mile distributors face. Yet the right kind of funding at the right time can be catalytic for these companies and the people they serve, while enabling investors to achieve their own financial and impact goals. Let's take a look at how 3 financial intermediaries have invested in last mile distributors at different stages of their growth journeys. Charm Impact provides loans to early-stage clean energy companies like Solibrium, who has reached over 6,000 last-mile customers in Kenya with off-grid solar lighting and home systems.
Our customers are those underserved communities that live in the rural parts of the country. The biggest challenge for households is affordability. What we do, we offer them clean and affordable solar solutions. With the introduction of pay-as-you-go system, it has created an avenue for many people to be able to afford or access electricity.
We like to think about our investments as crowding in investors, such as institutional investors, philanthropic investors who want to provide fast loss capital, and the retail investors who are interested in using their money to make an impact. The donor funding that comes in as fast loss capital allows the investors to say, well, if something happens to the company I'm investing in, there's someone taking a first hit.
This investment provides much needed inventory and receivables financing for Solibrium so they can purchase the products they need to keep up with demand, provide credit to customers, and scale their operations across Kenya.
Charm Impact, they're able to provide much smaller loans. That means they can support more local companies, more last mile distribution companies, filling a really important gap in the market. It also enables the donor money we use to be catalytic.
A little further along the capital continuum, Venture Builder provides equity to locally led companies looking to grow, like Energy Plus in Mali, who has successfully built a 20,000 strong last mile customer base in a very challenging market.
Energy Plus will sell solar systems for a low-income household. What we offer is a pay-go system that allows you to repay over a period of months, so it becomes cheaper monthly. So we needed an investor that understood our business, what we are trying to achieve.
Venture Builder, alongside Cord Aid Foundation, who provided debt funding, and the US African Development Foundation, who provided a grant, has helped Energy Plus to scale its operations across Mali, where 60% of people still live without access to modern electricity services.
We chose to invest in Energy Plus because we were very impressed by the founding team, which is a set of local Malian entrepreneurs who have successfully built and scaled multiple businesses in the country. Venture Builder's equity investment in Energy Plus has really allowed them to accelerate their pay-go solar model.
Venture Builder engagement helped us de-risk our investment so that we were able to make that investment. But on the other side, there's also a very strong social return that we are expecting to realize through this investment.
And thanks to funding from private foundations like Cabrini World, Beneficial Returns is able to provide substantial working capital for more mature companies looking to scale, like ATAC in Cambodia, who has reached almost 14,000 people with its biodigester technology.
ATAC started off in Cambodia when we were looking at how we can help farmers to access clean cooking. The ATAC biodigester is a product for farmers where they can take their waste, such as cow manure, pig manure, green waste, and put it into a biodigester system, which converts it into gas for cooking and fertilizer for farming. We're working in base of pyramid markets, where traditionally it's seen as a very risky approach. Customers that we work with very much want and need these products, but they can't afford to pay cash up front. They need to be able to break it down into small payments over time. That's only possible with beneficial returns and the debt investment that they put into ATAC.
We chose to work with ATAC because we think that they're having deep impact using market-based forces to eliminate poverty in Cambodia.
We were attracted to invest in beneficial returns as we think they're very unique in that they properly balance the impact and the finance approach to their underwriting. We, as investors, can feel confident are really truly working to benefit the lives of those that live in the communities that these companies work in.
Financial intermediaries are essential for the last mile distribution sector. They help channel investment to small and growing businesses in developing markets, balancing impact and investment goals, and provide advisory support to help distributors strengthen their businesses.
There's more than $1 trillion sitting in family foundations and donor-advised funds alone in the US. Meanwhile, there are thousands of social entrepreneurs trying hard to make a deep dent into poverty globally. Imagine what we could accomplish if we could combine that philanthropic capital and match it to those social entrepreneurs.
Specialist intermediaries are ready and able to bridge this gap to unlock impact at the last mile.
If you are still there, we hope you enjoyed that video, and we will come back in 2 minutes. So feel free to go stretch your legs, get a cup of tea and all that good stuff. Hi, Joe. Yes, it is very silent here because we just had a short break and now we are all coming back and we're just about to move into breakout groups. We also showed a short video during the break, but I did have one of our members message to say that he couldn't see the video. So hopefully some of you were able to see and hear that, that video. So where are we now? So now we're moving into the third and final part of the forum. Hopefully everyone's feeling energized and ready to get stuck into breakout groups. So this is all about designing solutions to fill the capital continuum gaps. So as you hopefully remember from Fede's presentation, we identified these 3 key areas where support's needed. So we came to all of you with a poll asking you which of these specific solutions you wanted to focus on. And you voted on the 6 that you can see here highlighted in red. So thank you very much for sharing your voting preferences. So the first is about building investment readiness tools for distributors. The second is increasing visibility of distributors and data sharing, including through something like an investment portal. The third is about collaboration through a dedicated alliance between 4 funders. Next, aggregating and de-risking debt investments to enable smaller ticket sizes. Next, receivables and inventory-backed financing for distributors. And finally, carbon financing and other forms of RBF. So we're going to move into breakout groups shortly. We'll ask you to choose the topic that you are most interested in or that you think that you can contribute the most to. Here is a quick reminder of how the next 50 minutes will run. We'll spend about 40 minutes in our breakout groups, and then we'll come back here to quickly report back, and we'll run a poll to get a sense for who's interested in driving forward which of these solutions. And we'll then wrap up and close, including talking about next steps. So in terms of how the breakout groups will run, so the goal is to discuss and further design some of these concrete solutions. Each breakout group will have a dedicated facilitator, and we will ask that someone from each breakout group feed back in plenary for 1 minute. So we're not looking for a summary of the conversation, but just 2 key insights and 1 action from each breakout group. So we're opening breakout groups. So at the bottom of your screen, you should see a breakout rooms icon with an option to join a breakout room. So please click on that and then click the breakout group that you want to join. So if for any reason you don't see this, or you're struggling to navigate Zoom, then just stay where you are and someone from the GDC team will help you find the right room. So good luck and enjoy the conversation, and we are looking forward to seeing you all back in plenary in about 40 minutes. We had 4 breakout groups. Charlie, are you able to give a 1-minute wrap from your breakout groups and kind of key insights or actions that we can take forward?
Yeah, sure. Let me jump straight into it. I think our group identified a range of different organizations that can play a kind of a financial intermediation role to aggregate small transactions and to enable capital to flow to smaller companies, including crowdfunding platforms, early stage equity and TA providers, manufacturers themselves, trade financing organizations, and local banks. In terms of the needs of those financial intermediaries, it really all boils down to liquidity and risk sharing. But also in the case of non-specialist intermediaries like the banks, a need for adapted systems and processes and real champions within those organizations that are well incentivized to make sure that deals actually happen. And I think, in closing, we felt that many of the specialist intermediaries, the potential intermediaries, are struggling to raise. And we saw a very clear need for more kind of de-risking capital, guarantee type capital for those intermediaries in order to enable them to scale up and to channel more funding to small companies.
Thank you very much. Nice and punchy. All right, Sarah, what about your group? Do you want to share back, or is someone else in your group sharing back?
For efficiency's sake, I'll share back, but it was a really great discussion among mostly investors talking about the fact that the reality is the reason that we don't collaborate more effectively is a lot of this is quite relationship based. It's based on like the person to person interaction to say, I've got a great company you should look at, or, hey, these were 20 companies that didn't meet our requirements, but that were solid, that might be of interest to you. By doing that person to person, it just slows us way down. And so we talked about what could we do, what system could we put in place to at least share the basic information that we're willing to share. There, I think there was raised quite quickly in the conversation. There are reasons that people don't share information. They don't feel comfortable sharing the information about their pipeline or about their portfolio and how it's performing. So let's acknowledge that and say, fine, what are we comfortable sharing? What basic level of information could we share with each other? And then how could we do that effectively? And one of the ideas that came up is if you're speaking to other investors as part of your diligence process, hopefully early on, you're speaking to other investors as part of your diligence process. You understand what they're looking for. They understand what you have available. If you decide not to move forward with a company, you can send it to a sort of centralized repository. We used GET.invest as an example, but I'm not saying that this is their job, but a grant-funded organization whose mandated is to collect the companies that are promising, that other investors are interested, and help direct them to the types of capital that they might be looking for. And wouldn't that be game-changing for our industry to know, here are all the investors, and here are the companies that are promising companies that other investors for XYZ reason didn't move forward. So we talked about whether that would be something that would be possible and maybe could be further explored among a set of investors.
Okay, thank you, Sarah. Nick, what about you and your group? You're talking about investment readiness. but you're on mute.
Thank you. Yes, we were talking about investment readiness and how we can support LMDs getting there. My head is swimming because we had a small group but covered a lot of topics. And it was a good mix of LMDs and some investors and technical assistance providers. I think Sarah made a good point that we also covered in our room, which is that a lot of this is relationship-based and it's sort of unique. So different investors and funders have different requirements, and it's not always the same. Something that was highlighted was that there's just a lot of confusion around that. For instance, investors might say we only support local founders, and LMD might not know what that actually means because that definition changes. So just either something around definitions could be helpful, or even just a practice of being more transparent with investors. It doesn't necessarily need to be something centralized. That's something that I was thinking about. We also just sort of confirmed something I think that GDC already knows, which is that some of the barriers are for LMDs is just having a very solid pitch, being able to communicate what they're working on, and also having good financials so that they can do forecasting. Some of the investors pointed out that these are some weaknesses that they see when people are applying for their programs. So no great ideas came out of this, but I think we understand our challenges a little bit more.
Okay, well, I think in 40 minutes, we weren't expecting you to like solve the problem of last mile distribution. And I think D-Prize has done a pretty good job in starting that anyway. Okay, so I think I had the last group talking about carbon finance and RBF, which is actually a really big topic. And I think we had 20 people in our group. So we needed a lot more time, but there was some really interesting conversations. We heard from Solstrom about their platform, which is working to bundle last mile distributors to reduce costs of verification to help them access carbon finance that they couldn't access otherwise. But there's a big challenge on the sale side of things. So how can we find ways to increase potential buyers for offsets that aren't part of some of these big, large certification programs? I think there's an interesting conversation. There was an interesting conversation in our group, which reflects a conversation that we have a lot at the GDC, which is how does this work across sectors? So how can we aggregate and monetize carbon credits across sectors? So if you've got companies selling water filters and companies selling off-grid solar, how can you devise a solution that works for both of them? And also more complex models. So someone like Off-Grid Box in Rwanda, whose business model involves selling purified water and clean energy in one product solution. So I think that's an interesting question for us. And then the final piece was about mainstream results-based financing. How do you really define results? And can we explore both opportunities to adapt existing RBF schemes, but also to create new RBF schemes that are targeting low-income consumers? And this is something that ESMAP is working to do in the energy space. So it's something that we're keen to collaborate closely with them on moving forward. Okay, so I think those were the 4 breakout groups. I think we started with 6, but there was some move around and we ended up with 4. So we have just a couple of minutes to close now. So here is a quick reminder of what the overarching objectives of today were. So we hope that you feel these objectives have been somewhat achieved. We've learned more about the sector. We've talked about a lot of different initiatives across the capital continuum, and we've had these conversations about solutions that the sector can take forward. So in terms of next steps, as mentioned at the beginning, we at the GDC see this as part of an ongoing conversation and set of ongoing activities and actions, and we're fully committed to driving this agenda forward. So as next steps, if you can just click, yes, we will be publishing the research that Fede presented and an event summary with some of the conversations captured. We're very happy to have follow-up one-to-one conversations or answer any specific questions that you might have that haven't been answered today. Nick and Sarah from D-Prize and Acumen are also going to be driving some of this forward. They already spoke a little bit about some of the instruments and interventions that they're currently collaborating on and are very open to new ideas and partnerships. So I think that's everything for now. We'd love to just launch a quick poll to get a sense from you about what you would like to see from the GDC moving forward based on the conversation that we have had today. So if you can please just have a look at this list and then select 1, 2, or 3 things that you really want to see from us over the next 12 months, that would be incredibly helpful in shaping our activities. So I'll just let this poll run for a minute, and we will share the results to hold ourselves accountable with what we should be working on. Okay, thank you very much. This is quite interesting. So there does seem to be a lot of appetite for more collaboration among investors, and that continues the demand that we have seen to date, and is part of the reason behind this forum in the first place. But there looks like there's quite a mix of interest in other activities as well. So we will take this conversation away, assess our strategy and our access to finance agenda, and come back to you with next steps. But finally, we would just like to say a huge thank you for your participation and your enthusiasm. And I think it's just incredibly exciting to see where the last mile distribution sector is today, because this conversation absolutely would not have been possible 3 years ago. And that's very much thank you to all of the stakeholders in the room and for all of your inputs into the work that we've done to date. So thank you very much. And we look forward to collaborating with you in the future. Thank you, everyone.